Welcome to This Explainer. Today, we're unpacking a massive fundamental paradigm shift drawn straight from our sources, including the 50-day finance curriculum. You know, everywhere you look, people are trying to teach you how to make money, how to double it, how to find the next big trend, how to get rich fast. But very few focus on the ultimate, often ignored prerequisite for actual wealth, how not to lose it. So we're going to see exactly why protecting your capital must come before you even think about growing it.
Okay, let's dive right into this illusion by contrasting two very different investors. Take investor A. They accept a steady, maybe kind of boring 12% return year after year for 5 years. Now contrast that with investor B, who chases high returns. They score 20% for 2 years, probably feeling like an absolute genius, but then, wham, they suffer a massive 50% drop. Most people spend their whole lives trying to be investor B on the way up, completely unprepared for the crash that inevitably leaves them poorer than investor A. The obsession with getting rich fast completely blinds us to this stark, objective reality. You cannot compound money that no longer exists. History is literally filled with brilliant people who made absolute fortunes and then lost it all. And the difference? It wasn't their intelligence. It was simply their lack of risk management.
Section 1. The Hidden Foundation. Why Wealth Needs Roots.
I want you to think of wealth exactly like a giant tree. Before a tree can grow taller and actually support the heavy branches of massive profit, it absolutely requires the deep, strong roots of protection. Most people focus entirely on the branches, right? They just want the growth. But without those roots, the very first strong wind of economic turbulence is going to topple the entire tree. Section 2. The Math of Loss. Why recovery is harder than it looks.
To really grasp why these roots are so necessary, we need to strip away all of the emotion and just look at the cold, hard math. If you start with 100 rupees and you suffer a 50% loss on the market, you're left with exactly 50 rupees. It's a simple, painful, and indisputable fact.
But here is the critical question that traps so many investors. And I want you to really think about this for a second. If you're sitting there with your remaining 50 rupees, what percentage return do you need to generate just to get back to your original 100? I bet most people instinctively guess 50%. But the shocking answer is 100%. Because a 50% gain on your remaining 50 rupees is only 25 bucks. You must literally double your money, a full 100% return, just to recover from a single 50% mistake. Small losses? Sure, those are manageable. But large losses create a massive mathematical trap that can take decades to escape. This stark math proves that surviving the downside is mathematically far more important than aggressively chasing the upside. Your first goal isn't buying the luxury car. Your very first goal is surviving the game long enough for compounding to actually work its magic. Section 3. The Unseen Threats. Risks beyond the stock market. You see, the crucial point here is that risk goes way beyond stocks. It's not just a red number flashing on a ticker. A decade of careful savings can be wiped out in an instant by sudden, non-market risks. We're talking about a medical emergency in the family, a sudden job loss, a business failure, falling victim to a scam, or unexpected major life expenses. Most financial disasters happen when preparation meets reality just a little too late. So what's the solution? Well, it's unglamorous but absolutely vital. First, acknowledge these non-market risks. Second, build a solid 3 to 6 month emergency fund. And third, secure appropriate insurance. Setting aside months of living expenses isn't exactly exciting, I know. It's not going to make you rich overnight, but it acts as an impenetrable shield, protecting your wealth from the absolute chaos of real life.
Section 4. The Danger of Leverage. When debt amplifies disaster.
Let's explore one of the fastest, most destructive ways people actively ruin their own wealth: leverage. Simply put, using borrowed money to invest. Easy loans and borrowed capital might artificially inflate your wins when things are going well, making you feel completely invincible. But leverage is a double-edged sword. When debt is involved, a small mistake doesn't just mean a small loss, it becomes an absolute financial catastrophe. Many financial crises start right here, because people start believing that prices will only ever go up, completely forgetting this profound truth. When your portfolio is all green, risk feels totally invisible. People take on loans beyond their affordability because they are so focused on the upside, they become completely blind to the devastating downside.
Section 5.
The concentration risk, the danger of the one basket.
Closely tied to the danger of leverage is another massive vulnerability. We have all heard the phrase, don't put all your eggs in one basket. Yet people constantly put everything they have into one single idea, one stock, one property, or one booming trend. They get overly confident. But when markets shift, industries pivot, or technology changes, which, let's face it, inevitably happens, they are left entirely exposed and ruined. The simple truth is that nobody, not analysts, not experts, not even billionaires, can predict the future with absolute certainty. The future doesn't reward certainty, it rewards preparation. And that is exactly why boring diversification is your ultimate defense. It ensures that even if you're completely wrong about one idea, your overall financial tree survives. Section 6. The Law of Survival. How survival guarantees growth. Let's pull everything together in this ultimate synthesis of our 50-day finance curriculum sources. The rule nobody teaches is that you must protect your capital first. Build that emergency fund, get the right insurance, avoid unnecessary debt and excessive leverage, and diversify intelligently. When you actually follow these steps, growth becomes exponentially easier because you've successfully guaranteed your financial survival.
It really comes down to this beautiful balance. Making good decisions and earning money is what builds your wealth. But keeping that money by aggressively avoiding bad decisions and managing risk is what preserves it. Doing both is the true, unglamorous secret to creating lasting financial freedom.
Remember, your goal isn't to become rich quickly. Your goal is to stay financially strong long enough for wealth to naturally happen. So I want to leave you with this final provocative thought to ponder as we wrap up this explainer. Income doesn't create wealth. Behavior does. Take a hard look at your own money right now. Is your financial behavior truly built to survive? Think about that for a bit, and we'll see you in the next explainer.